For years, this was just a theory, a possibility, a mathematical inevitability buried beneath layers of denial. We watched the charts, we tracked the short positions, we warned that one day the leverage would snap. And now, it has. While the world was distracted by holidays and headlines, something far more dangerous happened in the shadows of the financial system. No press conference, no announcement, just a quiet emergency signal flashing where only insiders look. In the early hours after Christmas, America's largest banks did something they swore they'd never need to do. They ran to the Federal Reserve, not for growth, not for expansion, but for survival. Billions in emergency liquidity, overnight. This wasn't routine, this wasn't seasonal, this was a confession. Because at the exact same moment, silver broke free, prices surged, vaults emptied, shorts panicked, and suddenly paper promises collided with physical reality. What you're witnessing isn't a rally, it's a failure cascade. The system didn't bend this time, it cracked. It didn't happen during market hours. It didn't come with a press conference. There was no breaking news banner. It happened quietly. Early morning, the Friday after Christmas, at 8:00 a.m. Eastern, when liquidity is thin and attention is dead, a number flashed across the Federal Reserve System. 1725 billion, not billion over a month, not billion over a quarter, in a single morning. This was the overnight repo facility, the emergency cash window of the global banking system. The place banks go only when no one else will lend to them. To understand why this matters, you need one mental image. The repo market is not a bank loan. It's a pawn shop. Healthy banks borrow from each other. Strong institutions never touch the Fed window. Using it is a confession. Former Fed Chair Paul Volcker once called it the place of last resort. Financial historian Niall Ferguson calls repo stress the first visible crack before systemic failure. So ask yourself this: why would the most powerful banks on earth need $17 billion in emergency cash? On a holiday Friday, right after silver exploded vertically? The timing isn't coincidence, it's correlation. Just hours earlier, silver gapped through resistance, leaping from the low 70s into the high 70s, a $5 move overnight. In futures markets, that's catastrophic. Each silver contract controls 5,000 ounces. A $1 move equals $5,000 per contract. A $5 move equals $25,000 per contract. Now scale that. Bullion banks don't hold 10 contracts, they hold thousands. At scale, a $5 move means billions in losses, instantly marked to market. And here's the part most people miss. Losses don't kill banks, margin calls do. The clearinghouse doesn't care about excuses. It doesn't care about narratives. It doesn't care if you think the price will come down tomorrow. It cares about cash today. When risk models break, computers issue demands, post collateral, or be liquidated. That $17 billion wasn't stimulus. It wasn't optimization. It wasn't year-end liquidity management. It was a tourniquet. Banks ran to the Fed, dumping treasuries like jewelry at a pawn counter just to stay alive until Monday. This exact pattern appeared in September 2019. Repo stress, emergency liquidity. Then, months later, full-blown intervention. Economic physicist Didier Sornet, known for modeling financial collapses, describes this phase as critical slowing before rupture. The system absorbs shock until it can't. And notice something else. This happened on a Friday. Banks fail on Fridays. Bad news hides on Fridays. Regulators seize institutions on Fridays. Because weekends buy time. Time to print. Time to patch. Time to hope no one notices. But markets notice patterns. And this one is loud. The repo spike tells us something fundamental broke beneath the surface. Not stocks, not crypto, collateral. Silver isn't just a commodity. It's a financial load-bearing beam inside the derivatives system. When its price moves violently, leverage snaps. And here's the chilling part. The Fed can print dollars in nanoseconds, but it cannot print silver. Every bailout solves cash stress while worsening the physical shortage. That's the trap. More dollars chasing fewer ounces. This 17B repo injection wasn't the end of the crisis. It was the first flare, a signal, a warning, a countdown. Because if silver moves again, if margin calls expand, this number doesn't stay 17 billion, it multiplies. And next time, the market won't be quiet. It wasn't stocks, it wasn't crypto, it wasn't housing, it was silver. A metal everyone was told didn't matter anymore. For decades, silver was dismissed as boring, industrial, old world, a pet rock. But beneath the surface, silver sat at the center of a massive leverage machine. And this week, that machine cracked. The panic didn't begin with headlines. It began with math. Silver moved fast, too fast. In less than 24 hours, price jumped over $5. That may not sound dramatic. Until you understand leverage, one silver futures contract controls 5,000 ounces. At $77 per ounce, that's $385,000 of exposure. backed by a fraction of that in cash, usually 10-15% margin. That means banks control hundreds of millions of ounces with paper and promises. This structure works until price accelerates. Physicist and risk theorist Benoit Mandelbrot warned that markets don't move smoothly. They jump, they gap, they fracture. Silver didn't climb, it jumped. When price gaps, risk models fail, VAR models explode, liquidity assumptions vanish. That's when fear enters the room. Every dollar silver rises creates billions in unrealized losses for institutions holding short exposure. But here's the critical line. Unrealized losses don't cause panic. Margin calls do. Clearinghouses don't wait for opinions. They don't debate narratives. They calculate risk in real time. And when silver crossed key levels, $72, then $75, then $77, those systems flipped. Red alerts, automatic demands, post-collateral. Now, this wasn't theoretical. At $70, a single bank short 50 million ounces loses $50 million per dollar move. Silver moved $5, and that's $250 million gone before breakfast. Multiply that across multiple banks, across multiple desks, across global markets. Suddenly, the problem wasn't silver, the problem was cash. Banks needed dollars immediately to stop forced liquidation. That's when panic becomes visible. They didn't sell stocks. They didn't sell bonds into the open market. They ran to the Federal Reserve, repo, overnight, emergency. This is where the system confesses weakness. Former BIS economist William White has long warned that modern crises start with collateral stress, not credit stress. Silver triggered collateral stress. Why silver? Because silver isn't just traded, it's pledged, leased, swapped, rehypothecated, the same ounces promised multiple times to multiple counterparties. When price spikes, those promises collide, and something else made it worse. Timing. This happened during Ghost Week. Thin liquidity, empty desks, algorithms dominating order flow. When sellers disappear, price doesn't move gradually, it teleports. That's exactly what happened. And once silver exposed the leverage, fear spread instantly. Banks don't panic because of one trade. They panic because of contagion. If silver breaks risk limits, what about gold? What about treasuries used as collateral? What about interest rate swaps tied to those desks? Silver was the spark. But the fire threatened everything. That's why the Fed moved fast. Not to save silver traders, to stop the system from unraveling. But here's the twist. By stepping in, they confirmed the fear. They admitted silver mattered. They admitted a metal, atomic number 47, formed in supernovas, limited by physics, had more power than balance sheets. This wasn't a rally anymore. It was a panic signal. And once panic enters, it doesn't leave quietly. Because silver didn't just rise, it revealed something. The system isn't fragile everywhere. It's fragile here. And now everyone is watching the same countdown. Next margin cycle, next delivery window, next price gap. Because if silver did this at $77, what happens at $85? What happens at $100? That question is already haunting risk desks worldwide. On paper, the system is infinite. On paper, there is always money. But reality doesn't live on paper. It lives in vaults, in warehouses, in atoms. This is the central conflict tearing the market apart right now. Liquidity versus reality. Liquidity is digital, elastic, created with keystrokes. Reality is physical, finite, obeys physics, not policy. For decades, liquidity always won. Whenever markets strained, central banks injected cash. Whenever prices rose, more paper supply appeared. Whenever shortages formed, derivatives filled the gap. It worked. As long as nobody asked for delivery. But that rule just broke. The moment silver surged, the system did what it always does. It created liquidity. Dollars appeared instantly. $17 billion, wired overnight. No mining, no refining, no transport, just numbers. This is the illusion of control. Economist Hyman Minsky warned that stability breeds instability. Long periods of calm encourage leverage. Leverage depends on confidence. Confidence assumes liquidity is always enough, until it isn't. Silver exposed that boundary, because liquidity solves only one problem, cash flow. It does not solve material flow. A silver futures contract promises 5,000 ounces, not dollars, ounces. When holders accept cash settlement, liquidity wins. When they demand metal, reality steps in. And reality doesn't care about repo facilities. Right now, the market is shifting from a liquidity-driven regime to a delivery-driven regime. That's rare and dangerous. In normal markets, futures volume collapses near expiration. Contracts roll, positions close. This time, they didn't. Contracts stood for delivery. Tens of millions of ounces demanded from vaults already drained by years of outflows. This is where the mismatch becomes visible. The Fed can create infinite dollars, but global mine supply is about 800 million ounces per year. much of it already spoken for by industry: solar panels, medical equipment, defense systems, batteries. Silver is not sitting idle. Geologist Keith Barron, known for resource depletion analysis, has warned that above-ground silver inventories are far thinner than reported. And once consumed, silver is often lost forever. You can't recycle what's dispersed. So when liquidity floods in, when dollars multiply, they all chase the same limited stock. That's inflation in its purest form. More claims? Same reality. This is why price moves are becoming violent. The market isn't repricing silver gradually. It's jumping between realities. One reality assumes paper control. The other assumes physical scarcity. Each gap is the system switching states. And here's the part that unsettles policymakers. Every liquidity injection meant to calm markets makes physical assets more valuable. It devalues the unit used to price them. So the harder the Fed fights volatility, the stronger reality pushes back. This is the feedback loop. Liquidity rises, currency weakens, silver rises, margin stress, more liquidity. There's no equilibrium here, only escalation. Physicist Joseph Tainter, who studied collapse dynamics, noted that complex systems fail when marginal returns turn negative. Each intervention solves less and costs more. We are there. The system is no longer fixing problems. It's buying time, and time is expensive because reality doesn't wait. Warehouses don't refill because dollars exist. Refineries don't speed up because liquidity expands. Mining projects don't appear overnight. Silver moves at the speed of geology. Markets move at the speed of panic. That gap is widening. And as it widens, one side must lose. Liquidity can keep prices elevated. It can keep banks alive. It can delay reckoning. But it cannot conjure atoms. That's the cliffhanger. Because the closer the market gets to delivery deadlines, the less liquidity matters. And the more reality takes control. The question isn't whether the system has enough money. It's whether it has enough silver. And that answer is getting louder by the day. The market didn't break on price. It broke on delivery. This is the moment every paper system fears, when contracts stop being traded and start being demanded. For years, silver futures functioned like a closed loop. Contracts opened, contracts closed. Very little metal ever moved. That illusion just collapsed. As prices surged, something unusual happened. Instead of rolling contracts forward, holders stood their ground. They said, "We want the metal." This is where a delivery crisis is born. A single COMEX silver contract equals 5,000 ounces. On expiration, the exchange must assign real bars, serial numbered, vaulted, audited. But the problem isn't total silver in existence. It's available silver. Registered inventory, the silver actually deliverable, has been draining for years. Most of what remains is eligible, not registered. Owned by someone else, not for sale. Paper claims ballooned. Physical supply shrank. That imbalance was manageable as long as delivery requests stayed small. They didn't. As first notice day approached, open interest refused to fall. Instead of the usual decline, contracts stacked up. Each one a demand for real metal. Warehouse reports began to flash warnings. Transfers increased, bars moved, but not fast enough. This is the choke point. Silver isn't cash. It can't be printed. It can't be rehypothecated endlessly without eventually colliding with reality. When registered inventory drops too low, the exchange faces a dilemma: force cash settlement or source metal at any price. Neither option is benign. Cash settlement shatters confidence. It signals that futures are no longer futures. They're options on trust. Sourcing metal at any price means bidding against industry, governments, and refiners. That's how squeezes form. This is why backwardation matters. When near-term silver trades above future months, the market is screaming one message: we want it now. Backwardation isn't a price signal, it's a stress signal. It tells you holders are unwilling to lend metal, even for a premium. Fear has replaced yield. This is not speculation, it's self-preservation. Industrial buyers can't pause production. Mints can't promise coins without blanks. Defense contracts can't wait for price stability. They need metal. And when physical demand collides with leveraged paper supply, the weakest link snaps first. Usually that link is the exchange. This is where history rhymes. In 1968, the London gold pool collapsed not because gold was expensive, but because it couldn't meet delivery. In 1980, silver didn't peak because demand fell. It peaked because the system intervened after delivery pressure spiraled. Delivery crises don't end quietly. They end with rule changes, margin hikes, position limits, emergency meetings, weekend announcements. We're already seeing the early signs. Higher margins discourage new longs, but they don't create metal. Limits reduce exposure, but they don't refill vaults. These tools manage optics, not physics. And here's the most dangerous part. Once market participants realize delivery is uncertain, everyone wants to be first. No one wants to be last in line holding a promise. That's the ignition. A delivery crisis doesn't require total depletion. It requires doubt. Doubt that your contract will be honored as written. That doubt has entered the system. From here, outcomes narrow. Either delivery pressure eases through price-induced demand destruction, or price must rise high enough to force metal out of hiding. There's no third option. Because silver is no longer being traded, it's being claimed. And once claims exceed reality, the fire spreads fast. The delivery crisis has ignited. What happens next won't be decided by charts, but by vault doors. This is the phase markets never forget. Not because of price, but because of behavior. Shorts didn't lose control gradually, they broke. For months, years, short positions in silver were calm, confident, mechanical. Algorithms sold rallies. Banks leaned on liquidity. Risk models assumed mean reversion. Silver was contained until it wasn't. When price surged through key levels, something subtle changed. The sell walls didn't reload. Normally, when silver spikes, offers appear instantly. Paper floods in. Rallies are smothered. This time, they didn't. That silence was the signal. Because shorts don't capitulate loudly. They capitulate suddenly. Capitulation isn't panic selling. It's forced buying. Every short position is a promise to deliver silver later. When price rises too fast, that promise becomes dangerous. At first, shorts hedge. They roll. They post margin. But margin isn't infinite. Each dollar higher multiplies stress non-linearly. Risk desks don't ask, do we believe silver should be here? They ask, can we survive if it goes higher? When the answer becomes unclear, the trade is over. That's when covering begins. Not strategically, not optimally, immediately. And here's the trap. In thin liquidity, covering doesn't push price up. It launches it. Shorts must buy into strength, into gaps, into empty order books. Every buy order lifts price. Every lift triggers new margin calls. Every margin call forces more buying. This is reflexivity in its purest form. George Soros described it best. Markets don't move toward equilibrium during stress. They move away from it. Silver entered that phase. You could see it in the tape. Rallies didn't retrace. Pullbacks vanished. Volume expanded after price moved, not before. That tells you who's in control. Not speculators, not longs, the shorts. Covering is not optional. It's survival. And survival has no price sensitivity. That's why traditional resistance levels failed. Why overbought meant nothing. Why technical stopped working. Because this wasn't trading anymore, it was exiting. Banks don't want profits in a crisis. They want the trade gone. And once the largest shorts start covering, the market structure changes permanently. Liquidity flips direction. What used to absorb buying becomes a vacuum. And here's the part retail never sees. Not all shorts can cover. Some are too big. Some are too entangled in swaps and leases. Some are structurally short because they promised metal they don't have. Those players don't capitulate first. They wait. They hope. They lobby. But hope isn't a hedge. As price rises, their optionality collapses. They're no longer trading silver. They're negotiating with time. This is why volatility explodes late and squeezes, not early. Early moves are belief-driven. Late moves are constraint-driven. And constraints don't care about narratives. They care about math. When enough shorts capitulate, the market enters a new regime. Price discovery resets. Volatility reprices upward. Confidence breaks. From that point on, rallies are no longer sold reflexively. They're respected. That's the inflection. Silver crossed it. Shorts didn't just lose money. They lost control. And once control is gone, price no longer asks permission. It moves until the structure changes, until supply emerges, until leverage clears, until the last weak promise is resolved. That process doesn't end cleanly. It ends when no one is left who must buy. And we are not there yet, because capitulation is contagious, and the biggest shorts are always the last to admit it's over. This isn't about interest rates. It's not about QE or balance sheets. It's about credibility. The Fed thought it could control markets. It thought it could guide liquidity. It thought it could manage expectations, until silver said no. Here's the trap. Market signals versus policy tools. The Fed can announce rates, adjust reserve requirements, or buy treasuries, but it cannot create physical silver. And when a market shortage hits, no policy lever fills it. Liquidity illusion collides with reality. Paper promises can be manipulated. Futures can be rolled. Banks can hedge until the market demands delivery and liquidity dries up. The Fed's tools are powerless. Margin calls versus mandates. Shorts are covering. Prices are moving violently. Margin calls are exploding. The Fed can't intervene without contradicting its own policies. Too much liquidity fuels inflation. Too little risks systemic collapse. Psychology of intervention. Every statement now is watched for weakness. Every hesitation is exploited by algos and traders. The market doesn't just react to policy, it tests it. The political dimension, silver moves, have global implications. China, India, and other players are watching. Any overt manipulation could backfire internationally. Result, the Fed is stuck between acting to stabilize markets risks undermining credibility and inflation targets. Standing aside lets the market resolve itself, potentially triggering panic. It's a classic liquidity trap, but with a twist. The trap isn't just in economics, it's in expectations. Silver's rally isn't just a market move, it's a mirror reflecting the limits of central bank control. Every spike forces the Fed to recalculate. Can we afford intervention? Can we allow market forces to dominate? Can we withstand political pressure if we do nothing? The answer is complicated, and that's why the market smells fear. Not in shorts, not in retail, but in the central bank itself. Because when the Fed is trapped, no one is safe. The Fed is trapped, and every move they make is now visible to the world. The game has changed. The shorts have fled. The delivery crisis is real. And the physical silver in your hands is the only thing that can't be printed, leveraged, or manipulated. This is the moment where history is written. Not on balance sheets, not in press conferences, but in real metal. What you do next matters. Will you sit on the sidelines, watching the system bend under its own weight? Or will you position yourself for the wealth transfer that is already underway? Subscribe now and stay ahead of the pivot. Because when the Fed is trapped, the next move is unstoppable. And the clock is ticking. Tick, tock. The metals are calling.